I want to thank everybody, as always, for joining us for coffee and conversation. I hope you have your coffee. I do. And, um, and I hope you enjoy what Michael will share with us today. And I want to introduce our guest today, Michael Arner, who is the Vice President uh, and hybrid long-term care specialist with Highland Capital. And Highland Capital is a firm that we work closely with when it comes to insurance needs for our clients. So Michael, I want to thank you first and foremost for joining me for coffee.
My pleasure.
Else with us. Michael's a real subject matter expert, and we're lucky to have him. So I do appreciate it. And I thought, if it's okay with everybody joining, that I'm going to ask a few questions of Michael, and feel free to use the double bubble question tab below, well, preferably the question box. Elise, okay, I'm sorry, I saw Elise joining. If you have questions for Michael, feel free to put them in there, and I promise that we will address them before we end. We usually take about 20 minutes, and I just have a few prepared questions for Michael and invite you, Michael, to take this wherever you might. But I think I shared with you that we have clients joining us today and their friends of a myriad of ages. So I thought first maybe we could talk about age and health and just get your insights from this perspective. We describe long-term care as a continuum of care, right? Because people think long-term care and think nursing home, and we want to make sure that people have a full understanding of the continuum of care that might be long-term care, from at home based, maybe a family member caring for them or a companion care, all the way to that stage of advanced or skilled nursing care. So that seems like, for a lot of our clients, many years away before they ever will have a need. So I want to get your thoughts about the timeline, when it's appropriate to start thinking about long-term care, and then ultimately, your thoughts on coverage. We'll start there if you don't mind.
Yeah, no, that's great. And thank you for the opportunity today to join you. Long-term care is the specialty that I work with here at Highland. So I do this for 5-6 days a week, honestly, and look forward to today's conversation with you and your folks that are joining us here online. First and foremost, it's hard to say when, because again, it's going to be unique for every person that we talk to. In general theory, most clients, I think, probably start to have the concern or pop up into their mind probably in their early to mid 50s. And most of the cases, that's usually driven by the fact that they're probably going through the experience with a family member now. So they're seeing it in live time, a parent or a family member who's going through a long-term care claim or illness, and they're at the front lines there. They're the ones that are either the caregiver or they're helping to direct the folks who are providing the care for an individual. So, from an age perspective, that's kind of in general rules where we start to see it as, folks that are in their 50s. But that carries, on through to 60s and into 70s. I mean, with respects to, the upper limits, obviously, the earlier you look at it, the better options you have from a health perspective. I think that's probably one of the bigger drivers, obviously, for the solutions here in general is overall health. And, in general theory, the younger you are, the healthier you are, right? So we don't want to have to take that for granted. The longer you wait, the longer you procrastinate, you potentially are putting your health at risk for looking at long-term care type of coverages.
They're pretty stringent, aren't they, in terms of it's not like underwriting for life insurance. They're looking for different things when it comes to underwriting for long-term care, right? What would be like a common example of something that we would think, oh, what's the big deal? I'll take a pill for that. But yet, if that medication shows up on your application, it might mean you're limiting your opportunity or potentially eliminating the chance to get coverage.
Yeah, with respects to the underwriting process, if you're comparing it to a straight, if you're applying for life insurance, If the client experience there is typically what I would call a full underwriting experience, meaning that they're going to ask for blood, urine, you're going to have to go through a gambit of questions. Somebody may have to come visit you at the house, right?
Right.
With these long-term care solutions, the hybrid benefit solutions particularly, it's more streamlined. It's a phone health interview with the client. So that they're going to get a phone call after application. They're going to go through their health history on the phone call. They'll look at prescription history to see, what medications a client's taking. And then they'll move it to an underwriting decision. It's a simple process. Now, the reason it's simplified is because they're looking more at the mobility issues of a client versus the
Okay.
mortality issues of a client. While there are some things that would be, technically what we would call a knockout, where it would prohibit a person from gaining access to a solution like this. In the LTC world, a lot of things that life insurance may frown at and say no, LTC may say yes with some conditions, because again, they're looking more at the mobility issue. So, some things that will catch us off guard would be things like hip replacement or knee replacement, right? If you get
Right.
older, that's a mobility issue. And when you're looking at time of claim, it's not being able to do 2 of the 6 ADLs. And those are activities
ADLs,
of
the
daily living.
activities of daily
Right. So like bathing, transferring, being able to feed yourself, get yourself dressed, those types of activities. And mobility is a key driver to most of those things. So I would say that, clients that are looking at these solutions, in most cases, the mobility issues are where we sometimes see some concerns. They're not always knockouts. I mean, I've had clients that have had knee replacements and hip replacements get approved for these solutions. More of that goes to then is, if you've had that done, are you having recurring issues with it? Are you still going
Yeah.
through rehabilitation, et cetera? So sometimes those things may cause delays, but by no means do they disqualify an individual from looking.
Outstanding. Yeah.
The one that I would say that does get us is when it comes to cancer. Cancer stage 3 or higher will always be an automatic knockout. So we've even had clients that have had breast cancer, stage 1. No additional recurrence, and we've been able to get policies for because essentially it's deemed corrected or cured at that point.
Right. How about, and this has come up a lot this year for us, I think given the state, the pandemic, and given the concerns over COVID, I think that a lot of people start looking and feeling somewhat anxious about their health, their well-being, and all of a sudden we're having more conversations. Is that changing anything in the realm of long-term care? And if so, like what does it look like? What do we need to be thinking about in the shadow of the pandemic?
Yeah, great question there too. The biggest change that we have seen since COVID-19, March of last year, we're coming up on a 1-year anniversary really, has been that most of the carriers are limiting or reducing their max issue age. So pre-COVID, we'd be able to, consider clients that would go up to age 80 for some of these different solutions. Post-COVID, a lot of the carriers have reduced their max issue age specific to multi-pay. So we have, there's different ways you can fund these types of solutions. You can pay with a lump sum up front, or you can, pay over time, 5 years, 10 years, 20 years, pay till 95, so to speak.
Right.
It's in that multi-pay space that we have seen the biggest impact to COVID, is that it's limiting clients to being under 70 now to having access to those multi-pay strategies. If you're over 70, we still have 2 carriers that we work with that will write cases up to age 75 and or 79 with another carrier. So we have 2 options, but we're limited to looking only at single pay premiums for those 2 carriers currently. Now, in talking with my internal partners with these folks, we're not going to see, I think, that change in the near future, unfortunately. Yeah. But again, we still have solutions, we still have strategies available that we can look at with clients, even though we do have some of those limitations right now. As far as underwriting goes, they do ask questions related to COVID, I believe now, on those phone health interviews, but it's not necessarily a knockout question.
Okay.
It's just more, I think, of, have you had it? What kind of reaction did you have to it? And have you recovered from it?
Yeah, there's still a lot of unknowns there, I suppose.
Correct.
Maybe
Correct.
right now less of an issue. That brings me, you made a comment about the modes of premium and how people pay.
Yeah.
that brings me to an area where I know that you have some real special expertise, and that is this idea of a hybrid plan. So um, I know for all my years that there were a lot more options years ago in terms of how you funded long-term care. By that, I just mean um, there'd be more opportunities for a 10-year pay or a one-time lump sum pay based on your age, some years ago, and more shared care options with your spouse. And I think our clients are all seeing this, and we hear from them, oh, I got a letter from my long-term care provider and it looks like costs are rising or benefits are shrinking. What are your thoughts just generally about how people pay, what things to consider, and then your area of expertise, this idea of a hybrid policy where it might mean the opportunity for a lump sum, maybe life insurance with a long-term care rider.
Yeah,
That's
that's a
myriad
great
of things,
transition
but
there.
if you
Yeah,
wouldn't mind.
it's several there, but we can hit on all three of
Yeah,
those.
great.
Just taking a step back a little bit, kind of lay of the land, going back 15, 20, 30 years ago, for the most part, traditional long-term care was probably the only option out there. So you probably have heard of companies like Genworth or John Hancock that wrote these types of policies for long-term care. They have annual premiums. Some would cover jointly, some would be individual. But the real pain point that we've started to see there is that these companies now are coming back and saying to the client, hey, we need more premium, or you need to reduce your benefit, right?
Right.
I have advisors that send me these letters from their clients all the time, say, please review this and give me some guidance as to what we should do here. Should we pare back the premium? Should we reduce the benefit? The client doesn't have the additional dollars to take the increase. So we do the analysis on that. In most cases, if a client has had one of those types of policies for more than 5 years, it's probably going to still be beneficial for them to hold it, because the power of the LTC pool, that long-term care pool that their dollars are buying for that future potential claim, are too valuable to walk away from.
Right.
Even
Right.
though
Agree.
in the traditional LTC world, we kind of look at that as call it renting coverage. It's kind of a use it or lose it proposition. If you have it and you need it, it covers the claim for the dollars that you've invested into it. But if you never use it, there's no value to it. It essentially expires. Where my role kind of then transitions is to say, there's a better way potentially to do this now with what we call a hybrid or linked benefit plan, where it puts an LTC policy and combines it with a life insurance policy. But the primary need is still having a large long-term care pool of assets to draw from for income should a claim arise. The death benefit here now is a secondary need. It's not the primary driver of why a client would look at this strategy.
Mm-hmm.
The policies that we look at are the carriers that offer these policies and solutions, also from a design perspective, have tried to make it easier for clients to have access, meaning it's not just lump sum anymore, where a client has to have 50 or 75 or $100,000 laying on the sidelines to look at a solution like this now.
Right.
They've gotten very crafty. They have 5, 10, 15, 20, even annual pay strategies where a client can spread the premiums over a length of time to make it more affordable to them and still get the coverage that they're looking for.
Yeah.
I think the biggest, whether you're looking at the traditional strategy or the hybrid strategy, I think it's also important to keep in mind that neither one is built to cover 100% of a client's expenses for a claim.
Right.
They are really more of a hedging position to offset some of the, the self-insure. So if your client doesn't have anything right now, their plan, whether they know it or not, is self-insurance.
Right.
And what that means is they're funding their LTC, their health, 100% out of what they have in their portfolio. By carving out a piece, whether it be an annual premium or a lump sum to a solution in the LTC space, they are now shifting some of that risk to an insurance company for future income, basically, to help offset having to self-insure. And that's the real driver here, is not having to have the client self-insure 100%.
I also think the benefit of this hybrid solution is you're right. One of the biggest complaints people have is, well, I've been paying on this premium for a long time, and it's one of those things you hope you never need. You hope you're never using it, right?
Right.
But being prudent and responsible and making those premiums, like you said, sort of running it to the end. This idea of the hybrid means someone's getting something in the end, right? I mean,
Bingo.
be paid, maybe it's long-term care, but if it isn't long-term care, then this, whatever that surviving benefit, that was the life insurance component, or, I mean, are there options where, I honestly don't know this. Are there options where there's a spouse that can benefit? Can you do something shared with a hybrid, or is it two hybrid plans when you have a husband and wife
Yeah.
covered?
In most cases, they're individual plans.
Okay.
There is one carrier that does offer a joint solution where we can have a survivorship policy. So taking a step back to what you said a minute ago, I think is spot on. Somebody's going to get something with a
Yeah.
hybrid linked benefit plan. So the client, the individual who's taking the policy out, they are either going to use the LTC pool for a long-term care need in the future. If they never use the LTC benefits, there's a death benefit that will pass tax-free to the beneficiary if they never use anything. And the third benefit that's on the table here is that if they decide at some point in the future they just want out, they want to walk away from the policy, there's either a cash surrender value where they can recoup some of the money they put in. In some cases, it's a vested 100% return of premium, where after a certain number of years, they can get all the money they put into it and walk away. That's not likely to happen, to be honest, because
Right.
the LTC pool is so large, or the death benefit is so, is so big that the return of premium doesn't make sense. But we know going into it that someone's going to receive something. And again, another, I think, way to contrast traditional to the hybrid benefit is specifically with the multi-pay feature. So if you have a client that's doing 10 annual premiums, we know that the hybrid benefit plans are going to give them guarantees, meaning that the premium, will never change. If your client is paying X, they will be paying X years 1, 2, 3, 4, 5, 6, 7, 8, 9, 10.
No letter from the insurance
The letter's not
company
coming from the insurance company to say, we messed up, we made a miscalculation on something, interest rates have gone in a different direction. We need to change your premium or change your benefits. It's contractually locked in and guaranteed. It's a fixed vehicle.
Well, the question I get about that when we explore it is, well, what if I don't need the death benefit? I don't need life insurance, and now I have to qualify for both a life insurance benefit and a long-term care benefit at the same time.
Well, so quite honestly, if we're comparing, this hybrid plan to, I would say, traditional life insurance, where we could attach a life or long-term care rider to it. So we kind of have two different, things that we could be looking at, two different roads or paths that we could look at. The life with LTC rider solution is actually a little harder, I think, to obtain because it's a full underwriting experience. With the hybrid linked benefit plans, even though it does have that, life death benefit piece to it, because of the underwriting being more towards the morbidity versus mortality, we do see a lot more favorable outcomes for underwriting.
So every plan isn't really designed to be life insurance with some sort of rider. You're saying this hybrid solution is driven more by what the long-term care need is than what the
Correct.
what does that mean?
Correct.
Just that more of the premium goes to covering a long-term care cost?
Correct. So so we were looking at illustration. And again, I don't want to get too far into the weeds here, but with respects to premiums, if you're paying an annual premium, most of the carriers will split that up on the illustration to show you what portion of the premium is being allocated to essentially buy the death benefit, and what portion of it is going to purchase the components that make up the long-term care pieces of the solution. And in some cases, those long-term care pieces can actually have some tax deductibility to a client when they go to file their tax return. Again, that's probably a separate topic, to be honest, because it does get into a lot of high level, advanced planning type of strategies, but just kind of at a high level, know that most of these solutions do have some additional tax advantages to your clients, because the long-term care portion of the premium they're paying may be able to be deductible from their tax return each year based upon different IRS guide limits that are put out on an annual basis.
For clients that have long-term care in place, maybe have had it in place for years, is there a rule of thumb? Is there, I think Elise is going to do a follow-up email and share local, like a long-term care costs in the Metro DC area maybe. But is there ever, do you ever see a hybrid used as a supplement? In other words, we went with the most economical possible plan at the beginning, and now we're thinking more realistically that it could be more costly. Is the
Yeah,
supplement a good
yes,
idea?
yes, again, that goes back, I think, to the point about, a client that maybe 5, 10, 15 years ago that took out a traditional long-term care policy. Now they're doing a review and they're saying, is it enough? Maybe it's they feel that it's inadequate for the metro area that they live in. The cost of care in the DC area is going to be much higher
Right.
or in any metro, compared to a more rural environment. I think that's just kind of rule of thumb around the country.
Right.
So, yes, I would say that we would say that, we have seen complementary builds, and there's nothing that prohibits somebody from having more than one policy.
Right.
Uh,
Good.
Definitely. And I've even seen strategies with the hybrid solution because they're leaner on the death benefit, where a client will take out a hybrid solution because of the rich LTC pool, and then supplement it with a term insurance policy for additional death benefit if they think that they still need that, as a
Right.
backup, so to speak.
That's a good tool. There are some questions that are rolling in. If you don't mind, I'm just going
No, yeah, let's take a few.
to. Is hybrid as effective at keeping up with the cost of care as a traditional policy? Great question.
Yeah, great question. So in both cases, we have the ability to build the solution using what we call an inflation protection index. In most cases, what you will see used most commonly is a 3% compound, meaning that the benefit day one will continue to grow year over year at a 3% compound. Most of the hybrid policies will give you the opportunity to look at, either 3% simple, 3% compound, 5% simple, or 5% compound. Now, that's kind of where my expertise comes into play, as to which one fits where, right? In most cases, for younger clients that are 40s, early 50s, mid 50s, we may go to a 5% compound because there's some cost associated with adding that to a policy. Whereas your clients that are 65, going up to 70, we may scale that back to a 3% compound or 3% simple. And then I would say for clients that are over 70, typically we'll look at just no inflation protection at all. And the reason behind that is simply potentially, statistically, they're closer to a potential benefit event. Statistics say the average age for a client to go on claim is around age 80. So, the worst thing that we would, I think, do is try to build something, put inflation on it, have a client have a misstep and need the benefit early, year 2 or year 3. And because of the cost of having the inflation index on there, they're getting a much lower starting benefit versus if we had just left it off and start them at a higher level, even though it's going to stay the same. It just, again, it gives them more meat on the bone.
Yeah, that really makes sense.
In those early years.
That brought to mind another question. With the hybrid, are we looking at the same sort of variables to control the costs, like the elimination period, or, as you said, a lower or higher inflation protection? What would be some of the others? But I mean,
yeah, the two biggest drivers there. So the number one is going to be age, right out of the gate. We talked about that on the onset. As far as the age of the client, that's going to be the biggest driver. The older the client, the higher the premium. It's that simple. When we get into more of the ancillary, tools that I have that I can, add or delete, so to speak, inflation index definitely is one that I think that does contribute to cost. So, having a 3% compound versus 5% compound on someone who's 65, 70 years old, you're going to see a significant decrease in the monthly benefit because of the cost of adding that index to it. Other ones that you might see, those are probably the primary two drivers, to be honest.
Okay.
Duration of the policy can sometimes have some effect too. So on average, we're looking at a 6-year benefit duration, meaning 6 years on claim.
Okay.
Industry averages.
Is that high? Is that what's?
Yeah. Industry averages. The industry average around the country is probably about 4 years.
4.
for time on claim. We look at six as kind of a carrier sweet spot for running, a solution like these hybrid benefit plans. That comes in, I think, backs into a little bit of, if a client has a memory or cognitive related illness or a history of it in the family, 6 years, definitely benefit that type of an individual.
Yeah.
And having those extra few years. In conversations with one of my carrier partners that works at One America, they have somebody on claim right now who's been on claim for 19 years with a cognitive illness. And that's a long time. That's a lot of strain on the family, right? But they had a benefit that they had selected because that carrier offers what they call a lifetime benefit option that allows that individual essentially will have dollars coming in, until end of life.
That does that even exist anymore? I don't think there's many.
It does yes. So the One America does still offer that lifetime coverage. There's a cost to it, of course. So, again, it's part of the equation that we have to weigh when we're running this for on an individual client basis.
Yep, and ours too, in terms of the conversation. So,
yeah, we just have so many tools at our disposal now, than we did 5-10 years ago to be able to craft these things to make them more, user friendly. But more importantly, I think, is to provide the benefits that the client really is looking for. So they don't have to worry about the self-insurance thing. They can kind of, they can rest at night knowing that they've got something to help.
I have another question, but I see other questions in the chat box or in the question box here. So let me see. What if you have more than one policy, which one takes precedence?
So it's up to the client. If the client has 2 policies, they can make claim on one. They can make claim on both at the same time. Actually, just going through the process right now with an advisor that I work with in Illinois, who's got husband and wife. They had old life insurance policies that had cash value, so they're 1035ing the cash value out of those
tax-free exchange
into a hybrid plan to give them long-term care benefits. And their plan is, the husband's amount was significantly higher than the wife's. Their plan is that if a long-term care event occurs, they're going to go into his first, let hers continue to grow because we put an inflation index on it, and then they'll go into that one as needed. So the short answer is that it doesn't matter the sequence in which you might use one or the other. You can use them together at the same time if it's advantageous to the client and they have costs that are increasing.
If the costs warrant
that's probably the biggest driver, right? If they have multiple policies and their cost of care is sufficient to meet the needs of just withdrawing from one, then just use that one and leave the others alone until you need them.
So my question, and I thank you. I think you've addressed a number of the key questions there. Some of them asked different ways, but the same question. By the time people start thinking about this, as you said, say they're in their 50s, maybe had an event with a parent and start to understand, hey, this could be really valuable. A lot of net worth is tied up in their retirement accounts, more so than individually. Is there ever a scenario, or is there a program or a tool to extract money without a tax burden? Or maybe there is a tax burden, but strategically speaking, have you done anything with retirement assets, like the amount of qualified money to fund a long-term care need?
Yeah, that's great, because again, that 55 to 65-year-old space right now, what we see typically is that they are overweighted in qualified funds and underweighted in non-qualified funds. We do have a carrier, I mentioned them earlier, One America. They have multiple different solutions that we have access to, but one of them that fits here specifically is a qualified strategy that allows an individual to make a qualified transfer to One America. It's a funneled or a bundled solution, so you kind of have to think of it as it's 2 buckets. The top bucket is a qualified annuity, so the money comes in keeps the tax treatment as being qualified. There's no taxable event there. Once it's received at One America, it gets a 20% income bonus on top of it. So if it's 100,000 coming over, your 100,000 now becomes 120,000. Okay. The second bucket underneath that annuity is going to be a whole life policy where the LTC benefits are derived. And that is going to be funded by taking 10 annual withdrawals from the annuity in equal amounts. So $12,000 each year for 10 years will be used as a funding mechanism to give the LTC benefits. Now, those distributions, those 10 equal distributions are taxable.
Right.
If the client is over, I guess, what's the new age, 72 now for RMD,
Right.
they can count towards your RMD. That whole life chassis, the bucket underneath, can be set up to either provide LTC benefits for the individual who had the qualified account, or it can be a joint policy where you can add the spouse on. So, I mean, there's lots of scenarios where you've only had one spouse, work for a number of years. They can be the funding source to create a benefit pool for both individuals. Now, that's usually where that lifetime benefit that I mentioned earlier will come into play, because
Yeah.
on that bucket of money, if we don't put a lifetime benefit on it, it creates a shared pool. Now, that may work great under certain scenarios, but what that simply means is that one person could exhaust an entire LTC pool on their own. If we put a lifetime benefit on there, that ensures that both individuals will have long-term care benefits as long as they live. So yes, that's kind of a long
That's
answer to it.
interesting. No, that's
Yeah,
good. I was
we are
first thinking,
seeing
well,
a
then why
lot-
wouldn't they
Yeah.
just extract 12 out, there's 10 equal payments out of the equivalent, but I think the answer is you're building it based on their age and their health in year one versus 10
Correct.
separate transactions. You're building it all at once with a
Right.
tax
So you could technically,
rollover.
technically, you could do it either way. What the One America solution, I think, does is provide a bundled solution where once that 100 goes in, I'm just using 100 as a round number.
Yeah,
Once the 100,000 goes in, it is now an autopilot. The client's not going to be responsible for calling up every year and saying, hey, I need to get a distribution from my IRA for $12,000 and net 10,
right.
and then send that money into fund a premium for an asset care solution or any other solution.
Right.
It's one and done. It makes one transfer, and everything else is on autopilot. The client doesn't have to worry about calling every year and saying, hey, I need a distribution. I got to make my annual premium. It's all automated, and client ends up with a nice, LTC pool benefit for either himself, herself, or both, to be able to provide, coverage should the need arise.
There are a lot of potential solutions, Michael. That's really,
It's continuing to grow, which is nice. But it's also fun. Sometimes it's challenging to keep up with all the different changes.
I'm reading through our questions here just to make sure that I think that addresses all of the, like I said, some said in different ways, and I apologize if I'm reading them in a hurry and missing something that's different than what we've asked of Michael so far. But I would I did want to mention too, Highland Brokerages, Highland Capital is an insurance brokerage firm. So Michael has no affiliation, much like us, the independents, with no affiliation and complete transparency in terms of these carriers and potential solutions. And so, I mean, I'm grateful that you're there as our subject matter expert, but also that you have a stable of potential solutions for us.
Yeah, I think that's what separates us apart essentially from a lot of other people is that, I don't represent John Hancock. I don't represent Pac Life.
Right, right.
I represent all these companies to a degree that I have the ability to go in and find the best solution that fits your client's needs and in an unbiased way. And at the end of the day, I think that's, what most advisors are looking for their clients is an unbiased decision on something that's going to be the right fit for their client.
Well, we are thrilled to have you as a resource, and I'm thrilled to have you today, Michael. So I appreciate it. And I certainly hope that everyone comes away a little more informed about everything from potential solutions to what's happening in light of the virus and considerations for when to get started and considerations for ways that they could possibly fund it. I know we'll continue the dialogue with our clients, and we certainly welcome all of you to come back to us with any questions you have specific to your situation or general for Michael, and we'll be sure to get back with his feedback. And Michael, thank you very much for your time today, for
No, this has been fun. I enjoyed
being a
it.
great support to Argent Bridge Advisors. We appreciate it.
My pleasure. Thank you for
All
having me.
right. Thanks, everyone.